We all dream of one day living off our riches, but how do we get there? To become independently wealthy, you'll need many different investment strategies. One option to consider is a dividend-focused portfolio. With persistence and good choices, a dividend portfolio could increase your passive income by $1,000 every month. First, what is a dividend? Simply put, a dividend is a payment companies make from their profits to those who hold their stock. Technically, when you own stock in a company, you are a part owner of that company. Or to put it another way, in exchange for your money, the company gives you a percentage of ownership. When a company is profitable, it will spend its profits in a variety of ways. One option is to pay the owners or shareholders, the people who own part of the company through stocks. This is called paying out dividends. If Apple earned $99.8 billion in profit last year, does that mean its shareholders split almost $100 billion in dividends? No. They paid out a lot, about $14 billion, but a company doesn't have to pay out all of its profits to its shareholders. A company can choose to invest its profits back into the company itself, growing it further, or they can even take their profits and invest in other companies, building an investment portfolio for the company. How do investors receive these dividends? They can be paid out through digital deposit, check, or even reinvested in more shares in the company. How often are dividends paid out? Companies decide how frequently to pay dividends, but most do so every 3 months, on a quarterly basis. Some stocks don't pay dividends at all. It's all up to the company to decide how often and how much to pay out. How much of that Apple dividend payout did each individual investor receive? It depends on how much stock they own. The more stock you own, the larger the percentage of the payout you will receive, though companies usually report their dividends by the per stock amount. For example, Apple paid out 4 times in 2022, usually at 23 cents a share. If you owned 100 shares in Apple, you would have been paid $23. Why is it only 23 cents per share? That's because Apple had 16.18 billion outstanding shares as of July 2022. Any dividend payment is going to be split equally among those shares. We're using Apple as an example, but there are other stocks with potentially better returns from dividends. How do we know which stocks are better for dividends? How do we compare them? One good way to tell which stocks perform better dividend-wise is to look at the formula for dividend yield. It's pretty simple. Take the annual dividends per share and divide that by the price per share. That will tell you the annual return on dividends on that stock. A higher dividend yield means more bang for your buck. Compare the dividend yield before making a purchase if you're trying to build a dividend-focused portfolio. For example, what's Apple's dividend yield? We know that they paid out 91 cents per share in 2022. On December 30th, 2022, Apple stock opened at $128.41. So you divide the annual dividend, 91 cents, by the stock price, $128.41. 91 cents divided by 128.41 is 0.7%. But people don't usually buy Apple stock for the dividends. If you are building a dividend portfolio, you want something more in the range of 2 to 6% for dividend yield. Obviously, I would not fall into this range. If you had a portfolio of stocks with a 2 to 6% yield, averaging out to around a 4% return on your portfolio, how much would you need to invest to make $1,000 per month? To get $1,000 in dividends every month with a 4% dividend yield, you need to invest at least $75,000. However, because stock values and dividend yields are not predictable and consistent, and most stocks return less than 4%, experts say that the ideal range is more like $300,000 to $400,000. Most of us don't have $400,000 to invest in dividend stocks at the moment. If you do, that's awesome. Go invest it right now. If you are like most people and don't have that kind of money ready, but want to start diversifying with the dividend portfolio, here's how you can start smart and build up over time. Start by selecting your ideal portfolio. That dividend yield we calculated earlier will be very helpful with this. Remember, we're shooting for stocks with a 2 to 6% dividend yield. When selecting your stocks, you want to pick at least 30 stocks in at least 10 different sectors. More can't hurt. Why so many different things? Diversification absorbs risk. Think about it like this. If you only buy carrot companies and then there's a carrot famine, your whole portfolio will dry up. Like any stock portfolio, what we're looking for is consistent growth over time, so buy more than just carrots. Commonly high yield sectors include financial institutions, real estate investment trusts, and energy, so start looking there. Risk is an even bigger factor with high dividend yield stocks because they are usually that way for a reason. Companies with high risk stocks use dividends to attract investors. That's why Apple doesn't need to pay huge dividends. The stock is probably going to keep going up on average over time, so people will buy it just for that. To try to mitigate some of the risk even further, don't just look at the stock's dividend yield this quarter. Look at how it has performed over the last couple years. The farther back you look, the more reliable your average will be. You can select some riskier, higher yield stocks that seem like they'll pay off right away, but make sure to balance these out with safer, more consistent stocks. Now that you've identified your perfect portfolio, figure out how much you can invest in it each month. Even if you have to start small, start now. Waiting will only lower your returns over time. Use whatever you can to start purchasing your ideal portfolio. As you purchase, keep in mind that you don't want any one stock to be the majority of your portfolio, even if it looks like it will have a really great yield. Experts recommend you don't want to invest more than 3% in any particular company. That means if you have a total portfolio of $10,000, you should have no more than 3% of that in any particular stock. 3% of $10,000 is $300, so if you want to buy XYZ stock at $100 a share, you should not buy more than 3 shares. Every month, when you buy more shares to increase your portfolio, revisit the relative value of your stocks and try to balance everything out with your new purchases. When you first start out, you should not only contribute regularly to your new portfolio, but you should also start making your dividends work for you. Reinvest your dividends back into the portfolio. This will help you grow even more quickly. The more quickly you deposit and the better you balance risk and reward by picking stocks with reasonably high yields and consistent performance, the faster your dividend account will grow. There are a lot of variables here, so if you don't have a huge amount of money to start with, we recommend learning more towards safer bets. Take a lower yield stock that's still about 2% that has a more consistent track record than something riskier. Also, make sure that as you take your dividends and reinvest them, you allot a percentage for tax liability. Depending on the rest of your income, your dividends can be taxed anywhere between 0 and 20%. A good place to start is 15%. Take 15% of every dividend payout and put it in a low risk or no risk savings account that you can easily withdraw come tax season. Remember, with dividends, you definitely get out what you put in. The more quickly you deposit, the faster your account will grow initially, and you'll be on your way to earning $1,000 every month in dividends. As you can tell, this is not a get-rich-quick strategy, but it is a good idea if you want to diversify your investment strategies. Remember, there is a lot of risk inherent in any stock market investment, and dividends do not have massive returns. Consider any dividend yield above 6% very carefully. That level of payout is often unsustainable, or it indicates many people are selling the stock and the price of the stock itself is plummeting. This makes sense if you look at the extreme cases. Why can't a company pay 100% dividend yield? Because that would mean that they are paying the entire value of the company back to the shareholders. This is why a dividend yield that is too high is often a warning sign. After all, don't you want the company to be using their capital to grow and not just paying it back to you? Unfortunately, this does put a cap on the heights dividends can usually take you to. We don't recommend this strategy if you don't have other sources of income or investments to fall back on. However, as a diversification method, it can be very helpful since it will have you purchasing and researching stocks you might not usually be interested in. If you are still in the building wealth stage of your financial journey, you can start with safer, faster ways to multiply your capital. In this video, we'll show you how to take your first $1,000 and grow it quickly.